Mortgage rates, meanwhile, dropping to a 3-year low amid today's sell-off. Diana Olick has that story from Washington. Diana.
Well, John, rates could move even lower today with the average on the 30-year fix dipping toward the mid-threes. Take a look. We were at 3.70% on Friday, according to Mortgage News Daily, and we started the year over 4.5%. So that's a pretty big savings for home buyers and owners alike. Very roughly, it comes out to about a $150 less per month payment on a $300,000 loan. It also means more people are eligible to refinance. How many? 8.2 million 30-year mortgage holders could likely both qualify for a refinance and save at least 3/4 of a percentage point off their current interest rate by doing so. That's according to a tally by Black Knight, a mortgage software and analytics company. Now, the size of that population, however, is still very sensitive to even the slightest rate moves because so many borrowers have already refinanced to those very record low rates. But it is always important to shop for your rate. About 1/3 of borrowers today do not shop. That's according to a new survey from Fannie Mae. Strange because the vast majority of us always shop for regular products and they do comparison shopping. Most say shopping for a mortgage, though, is more complicated and they just want to go with lenders they may already know and trust, even if it means leaving money on the table. I don't usually give advice, but I will say shop around for your best rates, especially when we're looking at such low rates as today. Back to you guys.
You know, Diana, though, I've been picking up in the refinancing market that it's not just directly correlated to obviously the drop in rates. Certainly that's very important. But the mortgage bond market also plays a role here in how many of these banks price these things. It hasn't backed up nearly as much as have rates. Has the move in mortgage rates been as strong as might seem to be reflected given this violent move down we've seen overall in interest rates?
Well, look, we always say that it's very loosely calibrated to the yield on the 10-year Treasury. That said, it's mortgage-backed bonds that create the rates on these mortgages. So you have to have investors who want to invest in these mortgage-backed bonds. The lower their return, the diminishing returns as rates go lower, the less they're going to want to invest in those bonds, and that could, put a floor on some of these rates. And also, lenders, obviously, they want refinance volume because it's been very low lately, but they also need to see returns as well. So there is some pushback when you do get to these levels, and that's why we don't see them really plunging the way we see the bond yields.